volatility. I mean, is this just
Mhm.
sophisticated money betting that the policy backstop still works? Can equities
Yep.
and gold both be right here? Stocks obviously pricing liquidity, AI optimism,
Mhm.
and gold, I guess, pricing sovereign risk. Who gets stuck with the bag?
Well, look, again, you can think of the S&P as a hedge against inflation. If the central bank is accommodative, you can actually see, again, it's no longer a price discovery, supply and demand driven S&P, Dow, and NASDAQ. And I'm not, again, the first to suggest this. It is a Fed driven market. It's no longer a dial, it's a switch. If the Fed is dovish, I'm bullish on the S&P. If the Fed is hawkish, I'm net short, because it's that simple. We've gotten it that distorted.
Yeah.
And if the Fed wants to accommodate the markets, there is no dip that can't become a V-shaped recovery if we're willing to print trillions of dollars, expand the balance sheet, and dump liquidity into the markets. If we're willing to do yield curve control and keep rates down, the S&P dragon slayers will buy back their own shares with cheap debt. You can always keep the bubble alive, but you can't do it without killing the currency. So it's running uphill in roller skates. It's a Pyrrhic victory. But yes, the S&P can rise if the Fed wants to effectively nationalize the stock market, which they've really done since 2008. Risk on, risk off, dovish or hawkish. Is that sad? Is that simple? To me, that's not capitalism. Again, that's just a centralized market. We also have, truthfully, if there's a war dividend, you can trade the war dividend. War typically feeds U.S. markets. When there's conflicts overseas, we see massive capital flows into at least the perceived relative safety of the U.S. Between 2003 and 2008, during the Iraq War, hundreds of billions of Middle Eastern dollars or assets rushed into U.S. markets, and the Dow rose steadily upwards. During the Vietnam War, where many of my family members were, the Dow gained 53%, while people were dropping like flies in Laos and Cambodia and North Vietnam. In World War I, the Dow nearly doubled. In World War II, it rose by 160%. And then as soon as those wars ended, that war dividend came crashing down. So, again, the combination of this temporary prosperity, permanent ruin of war can create a little bit of a tailwind for markets. The central banks can certainly support a market. There is no market correction that the Fed can't save, but not without killing the currency. So it's a Pyrrhic victory. You could try to hedge inflation in a very risky stock market that's at all-time highs by literally every metric. You look at the Buffett indicator with equities, the market cap to GDP. I think the bigger market equity and indicator, or the bigger Buffett indicator, is the fact that Berkshire Hathaway's $360 billion in cash. Again, these people aren't trying. Brilliant traders like Grantham and Buffett and Dalio aren't trying to time the market because it's a Fed-driven market. They simply don't trust it anymore. They can't value it. They can't evaluate it. As Charlie McKay says, valuation still matters. Price to book, price to earnings, all the things I learned in school don't matter if the Fed is supportive. But at some point, mean reversion returns. I can't time it. Nobody can. I do think the needle is in private credit and private equity in the private markets, just like it was in 2008. I can't time the day, but the signals will be that 10-year yield when it gets above 4.8. I'd be very, very bearish, and I'd be very concerned about leverage over leverage to try and get more yield, which is what Wall Street's doing. They don't learn a thing. They never do.
And when it gets close, you sure see a good headline to pop that 10-year down a little bit. Speaking of which, one odd headline this morning perfectly kind of highlights how Wall Street operates. CME Group is developing futures tied to computing power, and its CEO called compute now the new oil of the 21st century. Is that useful innovation or another sign that Wall Street will financialize every scarce input while ignoring the foundational debt problems?
I mean, Jeremy, you've answered the question. I mean, come on. We all know that this is, it's becoming worse than a Vegas casino. They'll try and find any way to financialize and expand risk and appeal to that addiction to try and get more yield or more return in a world that doesn't give you much, to speculate your way to safety. That's a very dangerous way to build wealth. It will be the best of times until it's not. I mean, I know even the Fed was going to do, if you trust the Fed, to do an investigation, because a lot of folks are trying to package some of this private equity and private credit bad loans or illiquid loans into asset-backed securities. Again, there's no shame in these people. They did the same thing with subprime mortgages in 2006, 2007. packaging horse crap and putting it in tinfoil and marketing it as investment grade. They'll try anything to get someone to go farther on the risk branch for some kind of return. And for a while, that'll pump until it dumps. And again, I've always said Wall Street will do this distribution phase where they'll use retail investors as plankton for their own distribution liquidity. And if you're not an insider, you're probably not going to win on that. You'll catch the first few hours of the fun and you'll get the last hours of the headache. And again, this is nothing new. I've seen it so many times. But packaging ABS subprime crap is nothing new. But they're even private credit is taking out loans to match redemption requests. They're putting leverage on leverage, taking out more debt to pay for bad debt. And heck, you can even use Harvard, the great Harvard. Its endowment has a massive private credit illiquidity problem. And they're taking out billions in loans because they can't get any liquidity on their crappy private credit. So the smartest guys in the room, the smartest guys in the classroom, the smartest endowment is stuck in a debt trap, in a liquidity trap too. This is not a time to be chasing tops and hoping for fantasy solutions. Yes, you can pick up dimes and quarters in front of this train, but I'm just not interested at this point, and I'd rather just sit back and watch gold and silver get the last laugh.
Yeah. It sounds like the risk has just been moved off balance sheets, renamed, rated, and
yeah.